Something big is happening in the silver market, and almost no one is talking about it. The price goes up, then suddenly crashes. Margin requirements jump. Speculators get shaken out. Headlines say normal correction. But behind the scenes, something much bigger is taking place. And if you focus on only one thing, just one, you will see the real story clearly. That one thing is deliveries. Welcome to Gold Silver Scope, where we don't follow noise. We follow the metal. Right now, the only metric that truly matters is how much silver is being taken for delivery from COMEX. Not the daily price swings, not the social media hype, not the fear. Deliveries tell you everything. In recent months, we have seen extreme volatility, sharp corrections, fast sell-offs. But these were not random. They were largely triggered by aggressive margin increases. When margin requirements are raised sharply, it forces traders to either add more capital or sell their positions. Many cannot add more capital, so they sell. That selling pushes prices down even more. It becomes a chain reaction. Open interest collapsed quickly. Some contracts rolled forward into the May silver contract, but many simply disappeared. They were shaken out. When margin requirements jumped massively, even strong businesses like refiners were hit hard. Imagine holding metal in production, not even fully refined yet, and suddenly facing margin call after margin call. That kind of pressure can cripple operations. But here's the key point. This looks like a one-time reset, not something that will repeat constantly. It appears designed to flush out weak hands and reposition large institutions. Now, let's step back. There are entities that have been bringing in massive amounts of silver month after month, not millions, but billions of dollars worth, with almost zero mainstream media coverage. And that is not an accident. Large institutional money does not act randomly. They do not commit billions unless they are extremely confident in the outcome. At that level, the most powerful asset is not capital. It is information. Smart money does not chase the puck. It moves to where the puck is going. We have seen this behavior before, especially with gold. Several years ago, central banks began repatriating gold from foreign vaults. For decades, much of the world's gold was stored in New York for convenience and legal security. It made sense during stable times. But then something changed. Countries like Germany, Austria, Hungary, Turkey, Poland, the Czech Republic, and the Netherlands began demanding their gold back. At first, many thought it was symbolic. But then something else happened. After repatriating gold, these same central banks began buying record amounts of gold, more than they had purchased in the previous 60 years combined. The following year, they doubled that amount. Then shortly after, global regulators reclassified gold as a Tier 1 asset under banking rules. Coincidence or preparation? Now look at silver. For 16 straight months, between 40 and 70 million ounces of silver have been delivered from COMEX every single month. Think about that carefully. A mint box of Silver Eagles contains 500 ounces and weighs about 42 pounds. Now multiply that by tens of millions of ounces. Every month, trucks upon trucks, physical metal leaving vaults. Who is taking it? Where is it going? Why is no one asking? In February alone, over 23 million ounces stood for delivery, and February is not even a primary delivery month. Traditionally, only about 1% of contracts stand for delivery. Most are cash settled or rolled forward. But recently, the majority of contracts are standing for delivery instead of cash settling. That is not normal. And it gets even more interesting. Over 38 million ounces actually left COMEX vaults in February. Not just contracts standing, physical metal leaving. That is billions of dollars worth of silver moving out of exchange-controlled inventory. Ask yourself a simple question. Who spends nearly $3 billion worth of capital to remove physical silver from exchange vaults during extreme volatility? This is not retail investors buying coins. This is large institutional capital positioning strategically. Meanwhile, silver has been reclassified as a critical mineral in the United States. Governments are discussing strategic stockpiles. Price floors are being talked about indirectly through policy language. Industrial demand is rising because silver is essential in solar panels, electronics, military applications, and green energy infrastructure. So when price collapses suddenly because of margin hikes, what really happened? Speculators were forced out. And at the bottom, major institutions quietly accumulated. Nothing fundamental changed. In fact, deliveries remain strong. Physical demand remains aggressive. Registered silver, the metal actually available for delivery, continues to decline relative to outstanding contracts. And this is where things start to get very interesting, because when the paper market promises more silver than is actually available for delivery, pressure builds. And pressure, in commodity markets, does not disappear. It releases. Now let's look deeper at the numbers, because this is where the real tension begins. In March, open interest in the silver contract was recently sitting near 47,000 contracts. Each contract represents 5,000 ounces. That equals roughly 239 million ounces of silver potentially standing for delivery. Now pause for a moment. 239 million ounces of potential delivery interest. But registered silver, the metal officially available for delivery in COMEX vaults, is around 88 million ounces. Do you see the imbalance? 239 million ounces that could stand against only 88 million ounces available. Of course, not every contract stands for delivery. Many will roll into the next active month, like May. Some will close out. That is normal. But here is the issue. Recently, far more contracts are standing for delivery than historical averages. Traditionally, only about 1% of contracts stand. Now we are seeing dramatically higher percentages. Even if only 30% stood, that would already stress the system. And this is happening while silver continues to leave vaults month after month. Where is it going? Some of it is flowing through large exchange-traded funds. When shares of major silver ETFs are created, authorized participants deposit physical silver into the fund in exchange for shares. But over the last few years, something unusual has happened. Instead of investors taking delivery directly from COMEX, some institutions deposit silver into ETFs and later redeem shares for physical metal. This method is more opaque. It avoids direct pressure headlines on the futures exchange. But the end result is the same. Physical silver leaves institutional vault systems. And when 38 million shares are created near a market bottom, that means someone delivered a massive amount of silver at those lower prices. The question is not whether it happened. The data confirms it happened. The real question is why. Why would institutions accumulate aggressively during engineered price collapses? Because volatility can be used strategically. When margin requirements spike dramatically, even wealthy traders with large accounts can be forced to liquidate. If you suddenly need 3 times more capital to hold your position, you may not have time to adjust. You sell. That selling accelerates the drop. Weak hands exit. Strong hands accumulate. This pattern is not new in financial markets. It is how liquidity is transferred. Now combine that with silver's industrial importance. Solar panel production continues expanding globally. Electric vehicle manufacturing requires silver. Military technology requires silver. Medical applications require silver. And with geopolitical tensions rising globally, governments are increasingly aware of supply chain vulnerabilities. Silver is not just a precious metal. It is a strategic industrial asset. Add to that the growing discussion of strategic stockpiles. Governments stockpile oil. They stockpile rare earth minerals. If silver is officially classified as critical, it becomes logical that strategic accumulation follows. And that brings us back to deliveries. 16 straight months of massive deliveries is not random behavior. It is coordinated capital movement. It is preparation. The market may look chaotic on the surface. Price crashes, rallies, volatility spikes. But underneath, physical metal continues moving out of exchange systems into stronger hands. And remember, once physical metal leaves the system, it does not easily return. That is the key difference between paper contracts and physical reality. Paper can expand infinitely. Physical supply cannot. When the spread between open interest and available registered inventory becomes too wide, the system depends on confidence. As long as most participants settle in cash or roll contracts, everything functions smoothly. But if confidence shifts, even slightly, the math becomes uncomfortable. And that discomfort is exactly what we are beginning to see build. So what does all of this mean? It means the recent volatility was likely engineered pressure, not a breakdown in fundamentals. Margin hikes forced liquidations. Open interest dropped. Prices fell quickly. But physical demand did not disappear. In fact, it accelerated. Large institutions are accumulating silver quietly. Deliveries remain historically elevated. Registered inventories remain tight compared to outstanding paper promises. Silver has been labeled critical. Industrial demand is rising structurally, not cyclically. Governments are aware of supply vulnerabilities. Strategic positioning is happening with little public discussion. And this is the most important point. Nothing fundamental has weakened. If anything, the imbalance between paper claims and physical supply has become more visible. Markets can suppress price temporarily through financial mechanisms like margin increases, but they cannot create physical metal. Eventually, price must reflect supply and demand realities. Now, timing is always uncertain. Markets can remain distorted longer than most expect. But when you see 239 million ounces of open interest against 88 million ounces of registered inventory, while tens of millions of ounces leave vaults every month, you understand why the situation deserves attention. This is not about panic. It is about positioning. The smartest capital in the world moves early. It absorbs volatility. It uses fear to accumulate. And that is exactly what appears to be happening. If you want clear, simple analysis focused on real data, not noise, make sure you stay connected with Gold Silver Scope. We follow the deliveries. We follow the inventory levels. We follow the structural shifts that most headlines ignore. Because in the end, the truth in metals markets is not found in daily price swings. It is found in who is taking the metal. And as always, this content is for informational and educational purposes only. It is not financial advice. Always do your own research and consult a qualified financial professional before making investment decisions. The silver market may get crazier from here, but when you understand the mechanics behind the scenes, you are no longer surprised. You are prepared.